Hello everyone, this is Mathematic Trading and this is video 1 from beginner to trade master. Today we're going to explain everything you need to know about support and resistance, also known as supply and demand. First of all, to avoid any confusions, I want to clarify that even if those concepts have two different names, for practical purposes, they are the same. The only difference is that supply and demand are normally represented by zones and support and resistances are represented by price levels. Anyway, call it what you prefer, the logics and trading rules are the same for both. Support and resistances is one of the most basic but useful technical tools you're going to need to make the best operations. It will help you decide your direction, to set your profit targets, and overall predict market movements. So let's get started. Supports occur on those prices where the downtrend stops due to the concentration of demand. Resistances occur when the uptrend stops due to the concentration of supply. When the market breaks those levels, supports become resistances and resistances become supports. It shows you where the price has strongly reacted one way or another, reversing and changing the trend, breaking and continuing the trend. To find one valid support or resistance, one single peak is enough, mainly because in this price the market has already shown some reaction. You can use the candle wick or candle close price. But normally we require a minimum of 2 peaks for confirmation. The more times the price touches this level or enters inside this zone, the more significant it becomes. For example, here we have 2 valid levels, and both can be used for trading, but this one has more peaks on it, so it means this level is more important. Market may react on every level, but those important ones will have stronger reactions. It will be harder to break, so you will see bigger reversals. And when they break, the followed movement will be more aggressive. Trading strategies. Now we are going to see some simple but highly efficient strategies you can use using those levels. Take profit. When you set your take profit above or below certain levels, you are more likely to touch it, mainly because the price wants to test that level. So, setting your profit target some pips before will ensure you exit with profits. Here we can see another example. You can perfectly set your target at the level in order to increase your gain. Here we can see another example. But if the market does not have enough momentum, it may reverse sooner and you may lose the opportunity to exit with profits. Stop loss. As you can deduce, the stop loss works contrary to the take profit. When you set below or above a certain level, you are less likely to reach it because the price will find resistance crossing that level. So, if your loss target is some pips after, it will ensure that you don't incorrectly close with loss, and the price may still go back to your break-even point or end up with profits. Like here, for example. Here we can see another example. Like here, for example. When you're trying to catch big movements, you can modify your stop loss when it changes from one zone to another. That way, you will protect your earnings in case the market reverses before you reach your profit. Like here, for example. This is known as trailing stop loss. To start your trades. When the price approaches or touches the level, you are in the perfect place to start one trade. This price is so good that either direction is a good opportunity. You only have to set your take profit and stop loss correctly. Both your trades may be profitable. For example, using the stop loss and the take profit rules we explained above, we can have two profitable trades even with contrary directions. Obviously, for the most profitable and the safest results, it's better to focus in one direction and trade accordingly to the market. So, when the price touches the level, we have two possible scenarios: reversal or breaking. Let's start with the reversal. This is one of the most conservative ways of trading because trading on reversal, you can also trade with one factor in your favor. You are in a good price, selling at higher prices and buying at lower prices. Like here, for example. Furthermore, the market often prefers to stay inside certain zones, so some type of reverse movement when approaching those supports and resistances is always present. This means that you can always gain some pips due to scalping. Scalping is a trading style which specializes in profiting off of small price movements. Like here, for example. Or, if you don't want to scalp, you can still use this concept setting your stop loss to break even in order to ensure that your order is fully protected. Like here, for example. As long as the level is not fully broken, reversal is possible. However, if the price keeps testing the level, it means the break is unavoidable. So you should place your trades in the direction of the trend. Here we can see another example. You can also expect the break of the level when the price approaches with a lot of momentum, like here, for example. If the price is moving aggressively to the level, it's a good opportunity to trade in the direction of the trend. Extra tip: when the market is moving quickly, your spread will be high, and you may end up with a bad entry price. Most of the times, prices normalize before continuing with the trend and gets back to the level. This is your best opportunity to get the best entry price and increase your profits. Here we can see one example. When the price fails to reach the contrary level, it's also a clear sign that this contrary movement is losing strength, so breaking the next level is very likely. So, it's a good opportunity to trade in the direction of the trend. Here we can see another example. Extra tip: low risk, high reward. When you're using those levels to start your trades, if you're confident the price is going in your direction, you can set your stop loss only a few pips below or above the same level. Your potential profit will be much higher than your possible losses. The odds will be in your favor. Some extra tips. Sometimes supports and resistances come in the form of round numbers, simply because people prefer those numbers. This isn't very relevant when you properly use the previous rules. However, it can be useful when the market is above certain unknown levels and we don't have any way to properly define the next possible resistance. For both directions, if you are uncertain of the direction of the market and you want to increase the odds of your trades, after the level is touched, you can wait certain pips, or wait, then exit this zone to confirm your direction. Here, for example, instead of trading when it breaks the level, we wait some pips for confirmation. Sometimes volatile markets can lead to fake breaks and seemingly wrong trades. It's hard to identify with precision in those scenarios because they're actually really rare. But this is not a major issue. When you set your stop loss correctly, your trade should be safe. Here, for example, our trade may look wrong, but using the previous rules to set our stop loss, we end up closing with profits. If you want to avoid losing trades with those fake breaks, you can wait certain pips to confirm your direction, as we explained before. Personally, I prefer to use price levels because it gives me a most accurate price to work with, and sometimes this precision can lead to better trades. But markets are not exact. There is always certain volatility you need to take into consideration. So at the end of the day, what I really use is this price level surrounded by certain zones. The indicator used in this video to automatically calculate the levels is the ultimate supply-demand. The expert advisor used in the video to manage your trades is the trade risk management. You will find the direct links to these in the description. Like this video to support us and subscribe for more content like this. Thank you everyone for watching and see you next time.